Okay, so a couple things I wanted to sort of follow up on. We are getting some questions about Magellan, but one thing I think that Sean said that was interesting that, we try to talk about a lot, or I guess I try to talk about a lot on these webinars is, when we look at the market, it is not actually absolute performance, but is performance compared to expectations, which is what Sean was talking about, looking at sort of what the market expectations are. So remember, even Magellan not doing great, if they don't do as bad as the market believes they will do, that is certainly a positive. So I just want to reiterate that. The other question I have, and Peter put through a question talking about sort of when Magellan will recover, where do you get your confidence, or what goes into your analysis that their performance will actually improve? Because obviously that's a very difficult thing to assess. So where do you sort of think that their performance will improve?
Well, thanks for the question. I think that's a fair one. I think when analyzing asset managers, we should look at the asset managers, but I think it's also important to look into the individual stock holdings. And here at Morningstar, we do have visibility into what our analysts globally are forecasting for these stocks. So, we have written about this a lot. We have recently put together a special report where we try to look into, the stock holdings of each of these fund managers that we cover, including Magellan. Essentially, what you would have seen in the recent months, and in fact, since the start of 2022, is that the outperformers or the underperformers or the growth managers or the value managers, they all have fallen off the cliff, uniformly. And I think, in this climate moving forward, where investors demand, where there's an increased emphasis on earnings as compared to, sales and non-earnings valuation methods, it's even more so to identify companies that can compound their earnings. And essentially what we have found when looking at Magellan stock holdings is that, firstly, before even stepping into the details, we all know that equity markets are, equity markets go up and down, right? Just because we have a bad year, it doesn't mean that future returns could be that bad. So it's the cyclical nature of the markets that supports our valuation. And to go a little bit more in detail, our findings, we have found that, across Magellan stock holdings, across its portfolios, their holdings are cheaper than the market, as I've said before. They are cheaper than the market, and they are expected to compound earnings faster than the market. So all in over the medium term, we are expecting these PE multiples and these stock prices to re-rate back to historical levels. And I think that's what consensus it is failing to understand. Consensus is either they are expecting just because they have a bad year, that means future year returns will be bad, and they are potentially more valuing this stock based on near-term earnings as well. So I think that's how I think about it. And I'll just go back to my original point about the company still having a sizable fund pool, and the compounding of that balance would be quite big. For example, if I were to look at Platinum Asset Management, for example, I think about over the past 5 to 6 years, the average outflow that they have is about $1.5 to $2 billion. I might be off on these figures, but when you look at that sort of outflows and you compare that with Platinum, with $20 billion worth of fund, if Platinum achieves a 10% return, that's $2 billion of market returns being offset by $2 billion of redemption. So all in, the money goes nowhere. But for Magellan, that 10% return on a $60 billion fund, it's enough to offset 3 years of redemption. So I think that's the thing that we are still positive on.
Yeah. Okay. Well, great. So Sean, and I'm going to get to you in 1 second, Alex, so don't worry. One more question that I think is related before we dive in later in the hour into, the buy now, pay later abyss. But before we get there, we have another question around asset managers. I thought we'd do this. So two different questions. So Angus is asking about what's going on and how much will Perpetual pay for Pendle? And then we have a question in general, sort of what your view from Paul is on Pendle. So maybe if you want to talk a little bit about what's going on Perpetual and Pendle, and then I guess your view on Pendle.
Look, thanks, guys. It's a good question, and I honestly do not know the answer to how much Perpetual will pay for Pendle. I think that's a lot of it is up in the air. I guess I'll just if we look at what Perpetual offered to pay in the past, that's about $6.23, and our valuation is currently $6.80. So I think that should give investors a ballpark on what to expect. Now, we all know that Perpetual itself is a value manager, and a value manager would buy stocks at a discount to its intrinsic value. So I expect, given the pullback in Pendle's share price and the disappointing flows over the recent months, which we have actually adjusted for just not too long ago, I expect Perpetual will try to come in at a low price. Now, whether or not Pendle's board will endorse that offer, I think we will need to watch. But in general, what we know about these two fund managers, in my opinion, there's significant uncertainty into how these two companies could join together. I mean, I felt that Perpetual could be trying to get scale, but as of currently, based on our understanding, the potential dyssynergies could outweigh the synergies, and there's a big overlap between the strategies. Number one, there's also potential staff losses, and potential for high retention costs. And if Perpetual buys Pendle and combine these two funds together, the fund sizes could get so big that limits the room for alpha, which is not, boutique like what Pendle clients want. And clients may also opt to pull out money, and bear in mind, based on my understanding, Mercer has put Pendle funds on watch. Now, both Perpetual and Pendle has similar, mix of public asset classes, limited private market assets. Both have value biased US funds. So I think that they are still, given the substantial overlap, they need to work this out very, very thoughtfully. And you don't want to wreak havoc, And if we just look at that Pendle as itself, we think it would take longer for flows to reverse back with further near-term redemptions due to, inadequate performance relative to peers. But what we should also remember is the recent stock market sell-off has sort of led to redemptions across all your traditional asset classes. So, there's rebalancing out of equities, there's rebalancing out of fixed income. You would run to fixed income, but you will get hit as well. So I think that sort of mayhem has affected Pendle a little bit. But we are still positive as a standalone. Pendle will return, and flows will return to certain channels, like say wholesale channels, PSW channels. But maybe 1 to 2 years up, beyond what we had initially expected. I think, given that its stock holdings are still cheap and its fees are actually quite competitive. But then again, Pendle has some challenge channels like Westpac, and the OWIC channels. So I think that it's just what the market has priced in for these companies, and try to make your investing decision from there.
All right, awesome. Thank you, Sean. So we're going to turn our attention over to Alex, but don't worry, you can mentally prepare for some buy now, pay later questions. But Alex, so a lot, obviously, as COVID occurred and is still occurring and has created all sorts of different changes in how people work and where they live and where they shop and everything else. Obviously, some of the companies that you have covered have been affected, but I think rather than me asking a summary question, we've got a couple interesting questions from Daryl, sort of around what is going on now. And obviously inflation is a big impact as well on all companies, but I think a lot of people look for real assets like real estate in inflationary environments. But I'll let Daryl ask the question. So Daryl says, generally in a growing inflationary environment, where are the highest cap rates seen? Office, industrial and logistics, or convenience retail? And then he says, conversely, in a stable inflationary environment where it's between 2 and 4%, where are the highest cap rates seen? So maybe if you could start out by explaining what capitalization rate is and why that's something we look at when we look at real estate. Let's start there, and then maybe we can get into different inflationary environments.
Yeah, sure. So the cap rate, it's really just a fancy term used in the property space for a yield. So if a cap rate on a physical office building is 5%, then crudely speaking, if it's a $100 million value office building, then it's generating $5 million worth of rent for that year at that time. And I did see some also some questions in the chat there about how that relates to the NTA, or net tangible assets of REITs. So really the net tangible assets is just the sum of what the REIT's physical assets are worth in the opinion of valuers. So it very much the NTA does kind of tend to be influenced by what's going on at the moment. It's not necessarily a kind of long-term look through the cycle, because what the valuers will do is typically they'll just look at what other property transactions are going on in the market in recent times. And so if you've got one building that's valued on a cap rate of 5%, it's earning $5 million of rent, and it's supposedly worth $100 million. If there's another building earning $10 million of rent, they'll just put that on the same cap rate, 5%, and let's say it's worth $200 million. But is it really worth $200 million? Well, if you want to kind of make a judgment on that, you've got to sort of be a bit more forward-looking in terms of what is going to happen to the rent, what is going to happen to inflation, interest rates, and the effect on cap rates. So generally, we've been kind of cautious. A lot of our valuations on the across the sector have been below the net tangible assets, really because we've been expecting the physical values to kind of come off a bit, and certainly the listed market now has sort of moved to more agreeing with us, and in some cases even gone further and is implying some pretty significant falls and arguably even a crash potentially in commercial property, based on what, if you look at what the listed market is saying versus the actual transaction prices in the physical property market. Now the degree of undervaluation there varies, so I can kind of get it more into that later on. But that there was another question in the Q&A there about, well, why have the, increased inflation and increased interest rates impacted the property sector so significantly? And that's a big part of the reason, the impact on the cap rates, or the potential impact on cap rates.
First of all, Alex, my job is to find the questions. I'm happy to go home if you're going to read them yourself. But anyway, getting back to sort of an inflationary environment. So, in general, I think the reason people like real assets is, of course, the simplistic explanation, which you can either tell me is completely wrong or not nuanced enough. But the simplistic explanation is, you got to spend a lot of money to build an office building in an inflationary environment where wages go up, where certainly the building materials go up. all of a sudden the building's worth more because to replace it would cost a lot more. And that's sort of why I think people sort of typically gravitate towards, a real asset like a lot of the companies that you cover, companies that own those real assets. What do you think about that? What do you think about that inflationary environment? And I guess across the different types of real estate, anything that you think would perform better or worse?
It's very much on a stock specific basis. Some of the REITs do have a little bit more kind of linkage to inflation in their leases. But by and large, though, it's overall it's a negative for the sector, really, because as I mentioned, there's that impact on interest rates, which then flows through to the cap rates, which is how how much the assets are worth. So rather than sort of thinking about which ones are kind of better placed to benefit from inflation, I think that's kind of a marginal play. There's kind of some slight differences in terms of how much inflation linkage there is in the leases. What we tend to look for is more just which ones are the cheapest, really. And so a couple of examples that we're seeing there, Mirvac is one that's trading at around about a 25% discount to its net tangible assets, which is kind of implying a pretty big fall in the value of its physical assets, and plus giving no credence, no kind of credit whatsoever for its development business and its funds management businesses, which are not part of, not factored into that net tangible asset calculation. So essentially, with a stock like Mirvac, you're getting a 25% buffer against falls in the physical property market, and arguably getting the development and funds management businesses for free.
Okay. What else? Is there something else? Am I correct in assuming that, when you're looking at valuation levels, that is your favorite play in the sector? Or are there other names out there that you think are attractive?
Mirvac's definitely one of the most attractive. It has been sold down because of those concerns about the RBA increasing interest rates and what that means for housing transaction volumes. But a lot of its sales are locked in certainly for the result that's due to come out in August, and quite a few of its sales are also not locked in, but they typically make sales and then they recognise the residential sales when the settlements occur, which is typically 6 to 12 months later. So they've already pre-sold pretty healthy number of apartments for fiscal 2023 as well. And furthermore, a big chunk of their balance sheet is either cash or inventory, almost completed apartments where they've already got sales contracts over those apartments. So we don't actually see it as risky as the market is implying, based on the Mirvac share price. And secondly, there's also been a lot of this concern around around housing developers or housing construction contractors going bust, and what that means for the sector. Now, it certainly is a risk, and things can become disorderly, but it's arguably a benefit for Mirvac that that they've got a strong brand, they've got a pretty strong balance sheet, and so as some of these competitors exit the market, it arguably puts them in a stronger position. So we view Mirvac as undervalued at the moment. Other names that I would highlight, probably a little bit more at the sort of riskier end, just in terms of having a lot of debt, but Unibail Rodamco Westfield is very undervalued. It's give or take on a price to earnings ratio of in the somewhere in the sort of mid to high single digits in terms of the PE ratio. It's not currently paying a dividend, but it is due to sort of recommence paying dividends in fiscal 2023, most likely. And it is quite levered, but it has one of the longest profiles in terms of having its debt locked in for getting up towards a decade. So it's not too exposed in the short term to rising interest rates. And it does also have a pretty credible plan to reduce that debt by selling assets. And it has been executing on those asset sales pretty much in line with the book values in terms of in line with its net tangible asset as recorded in its accounts. And yet it's trading at a massive discount to its tangible asset backing in the realms of 50% discount. So that's another name that looks undervalued. I'm happy to go through more of them. I don't know if there's any specific other questions that you wanted to ask, Mark.
Oh, I just assumed you would read through the questions, but let's go back to Sean for a second. And then we'll get back to you. So, Sean, we do need to talk, of course, about the dumpster fire that is the buy now, pay later space. So, I will give you a little pat on the back and a little bit of history. Sean, back when everybody and their mother was trying to invest in Zip and Afterpay, Sean came out and said that they are absurdly overvalued. I will say that we did a whole podcast episode based on your research, Sean, back in March of last year, saying that you'd have to be a lunatic to invest in these things. And, every once in a while we do have the opportunity to say, I told you so. But what is the story now? So we've got a couple specific questions about EML, and obviously there's been a lot of stuff going on there with CEO departure and Zip. So yeah, I don't know. You want to go through your view on kind of what's happened and sort of where you see from the future perspective, the opportunities, if there are any, for those two companies?
Look, thanks for that, Mark. Look, both Zip and EML are different businesses, but they all fall within. They all were sort of lumped up together with that fintech category. And good stocks, good fintechs, bad fintechs, they have all been derated as the interest rates go up. But look, I'll just start on Zip at the moment, and I think that it's important to go through what has happened actually in the buy now pay later sector. So I mean, and I'll first talk about buy now pay later and Zip, and then I'll talk about EML. But for the buy now pay later companies, we all know that it is a commoditized offering, right? And you need a lot of marketing, a lot of bad debts, and to give a lot of discounts, and you need funding to quickly scale up the business. Now, what has happened just 18 months ago, 12 to 18 months ago, is that these companies, they've created a massive following among investors to pump up their share prices. They then use this expensive share price to, raise capital, pursue acquisitions, pay themselves. Mark, I'm talking about the GameStop era, the meme stock era, where investors are just buying these stocks to chase the momentum. And the sell side was just, chasing the share price, valuing them off gross profits, ignoring things like working capital. Now, but what has happened is that as interest rates rise, a few things happen, right? Number one, investors get burned, and they just don't have the same risk appetite to buy these growth stocks anymore. Number two, people have other options to put their money in. And number three, there's just a greater emphasis on cash flows. So you get this domino effect that sees the share price of these buy now pay later firms collapsing, right? And at the same time, inflation means operating costs will be higher. So these buy now pay later firms find themselves in a very, I would say, a tricky situation. So on one hand, they need to spend more, but on the other hand, they can't get funding to grow. For them to get funding, they need to show investors they can make profits, but for them to get profits, they need to cut costs. But if they cut costs, they can't grow revenue. So, and hence why we're seeing talks about all these, all these mergers and acquisitions, right? So the rationale is to combine these companies, grow revenue, cut duplicate costs. And I think that that's where the industry will be headed to. I think the buy now, play the firms, the pure play buy now, play the firms are likely to lose some market share in the near term. Regulation would slow down how fast they can onboard customers and potentially reduce the spend per customer. But at a point of time, when interest rates and inflation normalizes, the dust would settle a bit, and by then there will be fewer survivors. And these fewer survivors presumably will be larger, having consolidated, and they will compete via lower fees, high credit risk, and trying to differentiate their product from the major banks. So I think that's the key to success over here. You need that scale. And unfortunately, what we've seen with Zip in recently is them walking away. So I would say, Zip, there's a, we've read the stock is undervalued, but I concur there's significant uncertainty in projecting their future cash flow simply because the company themselves don't know where they're going. If we rank the key to looking at fintechs is to look at which company has got a niche product, which company has got a focused strategy. And I would sort of rank Zip towards the very end because while Afterpay, Phineas and Tyro and EML are focused on growing, are single, minorly focused on one particular strategy and executing on that. Zip has just been throwing spaghetti on the walls. So you've seen them doing things like going into other markets but then pulling out, raising fees when everyone else is cutting fees, announcing that Sezzle is good and walking away from Sezzle. So there's just a fair bit of uncertainty in here. And I would say if you want to buy a fintech name, there are other stocks in the list that are better than the pure play buy now play the companies. Now I'll just quickly go through EML. Now EML, it's a for those who don't know, EML it's a prepaid card provider and a real-time payments provider as well. So I think the overhang around EML is that I think I saw a question. It was the share price was the plunge in the share price overdone? Well, in my opinion, investors have always oversold the stock. They have announced the same thing, which is the PFS regulatory issue in Ireland, and the stock price fell 2 or 3 times on top of the same announcement. Now, so I think the main source of uncertainty is people just don't know. Number one, people don't know how to quantify what's the impact, and then we would expect better disclosures around the earnings contribution from that division. But more importantly, is the source of uncertainty whether or not the Central Bank of Ireland, which investors would know, whether or not those restrictions would stay. Now, our discussions with EML has sort of indicated that the Central Bank of Ireland has, on paper they are saying that if they meet their remediation requirements, if they meet their remediation requirements, the growth caps would lift. But that itself is also a point of question because central banks, the Irish central bank tends to backflip a little bit. So there's a fair bit of uncertainty going on, but I think the important thing is to look at the long-term thematics. I'll just go back to the long term. With this new CEO change, it is disappointing. We were hoping that it could be handled more tactfully, but in all, we don't expect a change to the group strategy. We expect EML to focus on doing what he has been doing, right? Extending its capabilities across more users to enhance its value add, especially combining open banking technology with the prepaid cards to make sure that its products are portable. Because prepaid cards on itself, the usage of prepaid cards is expected to decline. So in order to survive, in order to make sure that they remain relevant, you need to add on some sort of better. You need to add on some form of icing on the cake, which is the open banking technology on top of the prepaid cards to build a good offering. But again, one last thing I'll talk about, which is to focus on the underlying fundamentals, right? What we know is that the customers are still comfortable with working with EML. You've seen contract wins from Correos, Traxys Tech, Upspin. You also see other parts of the business continuing to win contracts and customers. And lastly, clients are buying more products and are getting stickier. I mean, you read about the growing sales pipeline. You read about the retention rates exceeding 99%, off around 99%, and there were no client defections when the Central Bank of Ireland investigated, its Irish business. So this growth story and its strong fundamentals gives us some sort of conviction in the stock.
All right, great. Thank you, Sean. We'll go back to you, Alex. So we've got a couple questions, as I'm sure you're aware, around CLW. So yeah, I mean, we've got a couple of people that actually did purchase it. We've got questions around the price of petrol and diesel. You want to just give us sort of a summary of sort of your thoughts?
Yeah, sure. So CLW is the Charter Hall Long WALE REIT, and the unique feature about this is the incredibly long leases that it has. So WALE stands for weighted average lease expiry, and its average lease is in the ballpark of 10 years. So it again sort of talks to that perception out there that the REITs, the listed property trusts, are a little bit, in some ways, a little bit like bonds, because the earnings are fairly predictable. Now, it's not always true. So sometimes the earnings can be quite uncertain, but this particular REIT is at the sort of relatively more predictable end of things in terms of the earnings predictability, because of those long leases to quite strong big corporates and so on that are unlikely to, the tenants are unlikely to default or go bankrupt. So the NTA, or the net tangible assets backing for Charter Hall Long WALE, is about $5.90, if I remember correctly. But we actually valued it around about $5.10. Again, on that view that you can't value these things just based on rates being at near zero forever, and you can't value them just based on what properties are transacting in the market for at the moment. You've sort of got to take a bit more of a look through the cycle view. So yeah, the share price has come down. So originally, when we started covering it, the share price was a little expensive, not obscenely expensive. Now it's come down to sort of in the mid $4, maybe $4.50 or so off the top of my head. We're still comfortable with our $5.10 valuation. It does have, as I sort of talked about before, there's not a huge amount of difference between the REITs in terms of the linkage in the leases to inflation, but Charter Hall Long WALE probably is actually one of the few that has a reasonable, quite a reasonable amount of its leases linked. About half of its leases are linked to inflation, and so it's trading now on a yield of in the ballpark of 6 or 7%, and we're comfortable with that. I don't know when it'll, I can't predict when it would. We'd expect it to sort of go back to our fair value range. Our job is more to value them and not necessarily sort of predict, when the market is going to agree with us. But if I had to sort of pick potential catalysts, it could be potentially, once the RBA finishes its tightening cycle, regardless of what the RBA does, as it just continues to post reasonable earnings results, thanks to its strong tenant book, eventually, the market kind of tends to eventually follow the fundamentals. And there has been some commentary out there that in this kind of market, it's better to own REITs that have very short leases, so they can capitalize on rising inflation. I'm not necessarily kind of convinced that that's the case. Really, as a landlord, you're only going to do as well as your tenants are doing. And if your tenants are, suffering from inflation and all sorts of other uncertainties, cost pressures, and so on, that's, it's not necessarily a guarantee that you're going to be able to push through rental increases on, assets that are kind of vacant or leases that are expiring. So Charter Hall Long WALE's in a reasonable position there with its very long leases to strong tenants.
Now, do those leases, because we do have a question around, do they have any sort of CPI escalator? Do they have any mechanism for during the course of that lease for actually raising rent based on inflation?
Yeah, about half of their leases in terms of the income that they generate to Charter Hall Long WALE REIT, about half of those leases are linked to CPI.
Okay.
And the other half typically has kind of fixed uplifts, and the fixed uplifts aren't are nothing to sneeze at either. They're anywhere from it varies. I don't want to say every lease, but they're in the ballpark of 2 to 4% fixed uplifts, a lot of the leases. So that's pretty decent when you consider that the REIT's trading on a yield of in the ballpark of 6 or 7%, and plus in the long run the earnings should grow due to those CPI uplifts and the fixed uplifts built into the leases.
Okay, so you think, obviously a lot of people do invest in REITs for income. So you think that sort of their current payout is sustainable and obviously, as you said, a potential for growth?
Yeah, it's one of the REITs that's sort of moderately undervalued, but it's sort of at the lower sort of earnings risk end of things. So it's not one that I'd expect to be kind of dirt cheap, but it's the earnings and the distributions in the long run certainly look set to, well, nothing certain, but we expect them to grow.
Okay, awesome. So we are obviously have a little while to go, but maybe a question for both of you. So we've got a question from an anonymous attendee, which is where all the good questions come from, about stagflation. So obviously an environment where we're continuing to get inflation and we're not getting economic growth. So sort of, the worst of all possible worlds. And the question, and you can talk maybe about your own sectors, but also feel free to speak outside of what you actually cover. So the question is, what sectors would you exit quickly if that situation were to develop? And what sectors do you think would actually perform okay? So maybe starting with your own. So, you're on a roll, Alex. So maybe if you want to go next, and then we can talk about diversified financials in a second. What do you sort of think in that environment, how things would perform?
Look, what I'd say to that is, look, stagflation would be a bad environment for property of any description, but a lot of that is arguably priced in to the listed sector, which, as I mentioned, a lot of the REITs are trading at pretty big discounts to the net tangible assets. So I'd say what I would avoid is the physical commercial property, which, for example, the office sector, the physical assets are still trading at roughly the same prices as they were pre-COVID. So not only have you had the demand hit in terms of people working from home and so on, now you're having the hit to valuations potentially from higher interest rates, and yet these NTAs and the physical office values haven't moved. But what has moved is the listed sector is pricing in a lot of that bad news and is trading at big discounts in some cases to our valuations. So our valuations really are the those are our best forecasts in terms of weighing up those potential upsides and downside risks. So really, I just bring it back to looking at our fair value estimates, and not net tangible assets for property. It's an interesting guide, and it's certainly good to be aware of it. But as I mentioned, it's more of a barometer of what's going on in the physical property market at the moment. Doesn't necessarily indicate, how things might be playing out over the next few years. So I'd say get out of physical property and look at some of the undervalued listed property names.
Yeah, so that's actually an interesting point. Before we get to Sean, when we do talk about the market, the market certainly is priced with expectations on the future, right? So as we were talking about before, and as Sean mentioned around expectations. So I did think that was an interesting point, that, the price of the listed property is reflecting expectations for those NTAs to go down, where the NTAs is not looking at the future and sort of looking at what's happening right now. Just to summarize, if that's what you're saying, Alex.
Broadly speaking, it is, yeah.
Okay, awesome. So over to you, Sean. So what do you think when you think about an environment of moving into stagflation? What do you think about the names on your list, the diversified financial sector?
Hello, Mark and everyone. I think thanks for the good question. I don't want to sugarcoat this, right? The diversified financial sector is a high beta sector that's highly leveraged to market conditions. So one way or another, the stocks will be hit by rising, inflation and economic and depressing economic growth. I'll just go back to the main point about focusing on the key success factors. And before I go delve into it, I would echo Alex's point that a lot of the downside has already been priced in. And that's why the diversified financial sector is pretty undervalued across the board, because the market is being too pessimistic on its near term and tends to forget that things recover over time, unless of course someone hits a nuclear bomb button, right? Then that's out the story. But in our base case scenario, if we're able to look at the key success factors, and I would sort of urge our readers to refer to the economic mode section of our analyst reports. That's where a lot of the good stuff is in. But in the asset manager space, right? Asset managers will be hurt because stagflation is bad. It's bad for equities. So I think the key success factor over here is just to build up a diversified business that can provide optionality to your clients. And in the fintech space, I think it is important to build a product that is sticky, that is leveraged to structural growth thematics, and demonstrate a sustainable pathway towards profitability. For the business services companies that we cover, unfortunately, the guys like Credit Corp and Smart Group, they are not economic mode companies. So I think it's just a cost control story. But if I were to sort of think about the opportunities that I'll talk about, areas that you could hide, not so much hide, areas that you could consider, in the diversified financial sector. Look, I'll sort of pick out some names from each subsector, depending on various risk profiles. So in the wealth and asset manager space, number one, I would say have a look at Pinnacle and Magellan, right? Pinnacle is one company that has great diversity in its product offerings. A lot of its strategies are still getting new money when everyone else is losing money. Now, it has small strategies that can beat benchmarks consistently. There's earnings upside from new mandates, investment returns mixed towards higher margin retail money. And for Magellan, as I mentioned before, there's a huge margin of safety with the downside more than priced in. Its holdings are expected to re-rate, which should support improvements in performance and future flows, minimize future outflows, hopefully. And there are signs that stability is returning to the firm, and there are signs that its near-term track record is improving. Moving on to two growth stories that we can think about. Ironically, one company that I'll talk about is Challenger. So as an interest rate beneficiary, right? If we look at Challenger, sales are improving. It's trying to build switching costs from cross-selling more products. There are new products, new clients. It can get higher margins. It can sort of manage its annuity pricing. There's upside from Fidante partners. And another thing that I'll note is that there's upside option value from the bank and from the SimCorp JV that neither us nor consensus is pricing into our valuations. And for the fintech space, as I think as I might have alluded before, not all fintech is created equal. I would sort of, I would encourage investors to consider, to have a look at Fineos, right? Fineos Corporation has a huge margin of safety. It is the only pure play software provider for global life insurers who are, going through this structural trend of digitizing their businesses. On the revenue side, Fineos can make more money from more products per customer, more customers, expansion into new verticals, and it is also introducing a fee structure that can index its revenue to gross written premiums, to the premiums that these insurers are writing. And on the cost side, it can save costs from migrating customers to the cloud, and automating certain functions, hiring staff from cheaper countries. And if Fineos does not make another new acquisition, it should be able to self-fund its growth from here on. So I guess to summarize, I will try to look at names that have been excessively oversold and companies that are expected to that have a structural growth thematic behind them.
All right, awesome. So we're almost out of time. I'm going to do one more question for you both. I'm going to put you both on the spot. So we are coming up to August. So August, of course, is results season. There's been a lot that has happened since we last heard from companies. So a lot around inflation, interest rates. And during results season, just so you guys know, in the office, all the analysts are moping around because they have to all work all night for a month, but then they have a nice lunch afterwards. But what's going to be the biggest surprise, you think, in your coverage universe, either on the upside or downside in terms of expectations? So we're not talking about share price movements in the short term, but we've talked about this. Is there something in there that you think the market has gotten, or the expectations are very off from what we expect to see in August? So I know that's a hard question. You guys are probably going to get mad at me afterwards for asking it, but I thought I'd give it a shot. Who wants to go first? Don't all jump at the opportunity.
I can go first. I mean, just in terms of the two stocks that I highlighted as particularly undervalued, Unibail Rodamco, Westfield, and Mirvac. I'm expecting solid results from both of them. As I mentioned, a lot of Mirvac's sales for this year are looking, I never want to say locked in, but they already had sales contracts, and I'm expecting a good proportion of those to convert into settlements. And not only that, but they have a lot of sales contracts on hand that are due to sort of evolve into settlements in the next year. There may be some impacts from elevated costs, but as I mentioned, that's hitting industry wide, and it is actually taking out some of their competitors out of the market. So yes, there are some cost challenges in terms of developing new buildings, but almost every day I read about either there's some other rival construction company that's gone out of business, or there's a rival development that is being abandoned. Whereas Mirvac does a lot of its construction, it does its design, development, and construction from end to end in-house. It doesn't outsource it to these third-party construction firms that have been squeezed by kind of fixed price contracts, getting kind of squeezed by rising costs on construction. Everything's pretty much in-house for Mirvac. So we think they can not necessarily sail through, but manage their way through better than a lot of the rivals. So, and I expect that to sort of show up in results, this year and next year.
Okay, awesome. What about you, Sean? Once again, apologies for my question.
No, thanks for that, Mark. I think it's a very broad question because the sector is very diversified. So I'll try my best, right? For the wealth and asset managers, I think what I found is that there are a whole set of stale consensus numbers, and what I mean is that this earnings numbers could have been forecasted by the market about during March or during February, and at that point of time, the street is actually expecting the inflation or the rate rise led market downfall to be temporary. But what has happened is that the market continued to fall, and thus there could be some downwards surprise to these near-term earnings numbers because the farm pool for a lot of these wealth and asset managers have declined. And on top of that, what we've seen is that a broad-based redemption away from traditional asset classes, such as equities and fixed income. Now that could mean we have a slower starting farm, and flows could still be challenged in the near term. Now that's just a very broad observation. There are nuances across fund managers, but over the long term, I would sort of encourage people to sort of think about when markets are cyclical, when markets recover, and flows would come back. So I would say watch this space, watch our reports. With regards to the fintechs, again, the fintechs is an interesting space because in the past the sell side has been chasing the share prices and started more putting in astronomical forecasts to just chase the share price. And what we've seen in recent times is the fintech saying, hold on, we can't grow that much and we need to incur more costs. And and as such, the reason why a lot of fintechs has been falling is because the sell side has also been adjusting, paring back their forecasts. So we could see some earnings downgrades as companies talk about rising costs, and they might not be able to grow that quickly. But on the flip side, where things could come true is if the companies demonstrate a sustainable pathway towards profitability. So a lot of these companies will want to show that they can make profits. So you would see things like paring back costs, focusing on its core markets, and if they can demonstrate that either the losses are reducing or clients are paying more money, then there could potentially be an upward surprise for a company. And I would say a company that I like to look at as a forward indicator to everyone is Credit Corp. Now Credit Corp reports I think in early August, and their observations would sort of paint an overview of where the global economy, on where advanced economies is growing. So in the near term, we are expecting the bad debt supply to increase, but there could be but there could be further amortizations, and there could be further delinquencies along the horizon. So I think I would say it's a very fluid space because the DeFi market is so leveraged to macro conditions. But I would say again I'll come back to focusing on the long term, focusing on what the market has priced in, and watch our reports.
All right, awesome, great place to end. So join me in thanking Sean and Alex. I appreciate it. You've gotten through your turn on the analyst webinars. So we'll move on to two of your colleagues next time we do this. So lucky you guys get to go to the back of the line again. But anyway, thank you guys very much for joining. As always, if you have any questions, you can shoot them to me at mark.lamonica1@morningstar.com. And I'll be back on Thursday and I'll have to talk again, which is too bad. But anyway, thank you guys for joining and hope you have a good night.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.